Now, this Basel III thing, and I know that our viewers will want to understand the requirements. Let's break it down a little bit. Let me stick to, okay, let me come to Oji, and I'll come back to Ayo.
Okay.
What does this entail? Because everyone out there wants to understand, what does Basel III mean?
The Basel Committee actually is an international association, kind of central banks of certain countries. It actually started off, with the G10, what we call the G10 countries, sometime in 1974. Okay, when for the first time there was a global concern about settlement risk in international banking, when the bank called Bankers Hastad, had a major issue in Germany, where they were unable to make some necessary settlements because they were closed down. So it became necessary for the whole world to look at a common way of measuring the health of banks across boundaries, across continents, such that when you are dealing with a bank in Asia or in America or in Europe, you are comforted that this bank, based on the Basel standard, they are strong enough. So because of we call it the Basel Committee for Banking Supervision. All right, that's the general name. So initially the focus was on capital adequacy. That's Basel I. So Basel I came out around late 70s. After they met over that Bankers Hastad issue, and they came out, how can we make banks across the world be equally measured or rated? So they brought out the issue of capital adequacy. But over time, a lot of other lapses came up. I have to summarize this. It's actually a long background. But due to some issues, lapses that existed in Basel I, there was an upgrade to Basel II. And Basel II basically had three pillars. The first pillar is pillar of capital adequacy. Second pillar is regulatory framework, monitoring this adequacy by regulatory bodies, both internal regulation and the systemic regulation by, let's say, the central banks. And then the third pillar is pillar of market discipline, talking about ethics and governance in the way we carry out our trading books and all of that. But after Basel II, we thought we had got everything right. The issue of what capital will count for your capital adequacy, tier 1, tier 2, tier 3 capital, and what ratio of which will be constituted to check how healthy you were in terms of capital adequacy. We thought we had got it right. But a few loopholes also existed, such that the growth of the derivatives market in the US that exposed the whole world to the last global crisis also showed that the Basel II was still imperfect. There were issues of liquidity that existed. There were issues of governance problems, lack of ethics and governance, market discipline issues, basically. So Basel III just came out to enhance Basel II. That's why the three pillars still stand, but it's now enhanced. Pillar 1 is now enhanced capital adequacy. Pillar 2, enhanced regulatory monitoring and framework, and then enhanced market discipline. So the whole Basel thing is about a uniform way of checking or rating the viability or the strength or the health of banks across the globe. And for a bank to be rated internationally, to be seen as internationally viable bank, you have to keep to those. It's not compulsory. Many nations have not joined the Basel Accord yet, but it's a common way of looking at how healthy banks are. And for Nigeria, we always try to make sure we get ourselves.
We follow the global trend.
Yeah,
okay, let me come to Ayo. Ayo, what's your own view about this, the Basel III Accord? What impact is it supposed to have on our own financial markets, the banks especially?
Okay, Oji has done justice to how the Basel III existed and how the history behind Basel III. And based on what CBN is saying, the impact, what we expect now is it's going to open Nigerian banks to, there will be increased credit lines for Nigeria, because there will be like a uniform way to measure how strong the banks are. So some of the banks, the foreign banks, will be able to measure and they'll be able to do more business with Nigerian banks. Then in addition to that, based on what CBN currently is saying is that the ratio will still be universal. It should, the ratio is around 8%, but they are still holding on to the current 15% for international banks and 10% for the national banks, which means that it will be more stringent, and this will boost confidence. So if that means you have almost a premium of about 700 basis points above the normal 8%, which you use to assess the ultimate of universal bank. But then in addition to that, what also this Basel will also do is, what they are trying to say is, if it's going to, in terms of the kind of risk that you intend to take, in the kind of business you intend to expand, try and create capital that can cover up for this risk. So they're trying to see how, such that if the business, maybe you open a branch and at the end of the day it goes not as planned, then the capital that is lost does not affect the total capital of the company. Your capital can easily absorb the provision that will be made to take up the money lost in that particular aspect. So it's going to boost confidence for the international banks, and we should expect that there will be more business for some of our banks, which will also help them to make more money.
And note that there's a concept of economic capital in Basel III and a counter-cyclical capital. So whether you expect some losses from your business or not, you must provide some buffer capital. That's why beyond the 8%, the minimum now appears to be somewhere around 10%. But for this GC, what I've called the global, systemically important banks, is as high as 13%. But for Nigeria, the central bank will be pushing for minimum of 15%. Is a good and safe position for us. Just to add to what Ayo has said.
Okay, let's now look at the numbers very quickly. Let's take a closer look at the numbers and the figures that we've gotten in terms of how much the banks are gearing up to invest. The figure is at $3.623 billion. Now that's an equivalent of 598 billion in the power sector. Ayo, let me come to you. Now, when we hear these figures as to how much banks are willing to invest, do you think that it's painting the right picture of having to support the power sector when we look at the fact that even this Gencos and Discos have some monies with them from the banks that haven't paid back? What do you think may likely be the situation?
Firstly, I would like to, I think what is giving some of these banks more confidence is they recently set up stabilization fund to take care of the backlogs of the repayment that have not been gotten. So for some of the banks...
How far have they succeeded in that?
No, it's a very recent development,
okay,
which we can't easily measure how successful it is for now. I think it was about just less than a month, which the government came out when they discovered that the banks are becoming worried about the repayment of the loans. So that has geared up more interest in some of the banks that did not participate in supporting the Gencos and the Discos. And currently they're trying to, the process of, privatization process of the NIPP has also started. So they need about $5.8 billion. And when we discovered that most of the foreign banks or foreign interests are not participating in this, for the government to encourage some of these banks, that is why some of these funds have been set up. But we need to be very careful because some of the challenges still exist. Yes, the government has set out a guideline that if you want to, if the Gencos, Discos, the TCN, NBET, if they want to participate in accessing this particular fund, they need to fulfill some of these obligations, which we feel that some of them may be very difficult for some of the banks, for some of the companies to fulfill. So additional almost 598 billion is also putting the bank at risk because currently non-performing loan is still less than the 5% threshold of the CBN. We may, in the midterm, we may see the non-performing loan skyrocketing significantly to above the 5%, which would trigger an alert to even foreign investors.
Okay, when we look at the fact that banks usually go to borrow from abroad because of the low interest rate, not just the banks, even companies, they look at the single-digit interest rate, free money, as they usually call them, but low interest rate. When we compare the fact that it's a bit difficult to even raise money from within, and we have to go out of our shores to get money, the interest that will accrue from this, from these funds, of course, is expected to be paid back to the countries where these monies are paid for. But what does that say about the ability of the Nigerian economy to fund such capital-intensive projects without having to go the whole hog of going outside of the country? Oji.
Yeah, the issue of capital is a major issue. In fact, it's a bit paradoxical for me when you consider Africa and Nigeria, basically. Yes, we always run abroad to go and look for cheaper funds, and more stable funds, longer turnout funds. But the question is, don't we have capital in Africa to develop Africa?
The ADB, I understand that the ADB, the African Development Bank, is also trying to do something, but we do not know to what extent that, assistance will go to aid the power sector.
Yeah, the point I was going to make is that, for us to be pursuing cheaper funds abroad, some things had been done to stabilize the kind of funds in those economies, in terms of financial inclusion, in terms of, ability, confidence in the financial system, so that people can keep the money for a long time in that economy. And then most of the money is also coming from Africa always end up in those economies, and where they are always forgotten, and they constitute part of the stable funds in those foreign countries. So why can't we fix our own financial system such that the confidence in that system will be so robust that people can keep their monies on a stable term? So it's a big problem. So banks always have to keep looking for opportunities to make money. What is driving looking for foreign debt, is always about getting cheaper cheaper loans. So when you, most times as on-lending facilities. So when you lend them out, you can still have a good margin to make profit. That's a major concern. But for me, beyond those debts, what other ways can we, use to finance the power sector? Looking at equity, looking at the bonds market, even local bonds market. Looking at other, kinds of financing opportunities. But for me, the banks will do their best. But government has a lot of role to play here, in ensuring that this sector, kicks off on a very good note. And that's what I think the CBN is trying to do now by bringing what they have called the intervention fund to support the sector. But that's the issues are plenty. For me, banks are always looking at how can their money be repaid. In all this discussion, we haven't even looked at revenue generation by these companies that will enable them pay back the loans they are taking. How are we going to ensure that the users of this services, the power sector services, that the users, you and I, are able to pay the right price for these things and pay at the right time? A lot of revenue is still being lost in the streets of Nigeria because people are not paying. And without revenue being generated, whether the fund is provided by government or by a bank, there will still be, a default somewhere. And once there's a risk of default, banks will not lend. Banks will not be encouraged. So we have to be looking at the two sides: how to get the money to fund the sector, and how to make sure that the sector has sufficient cash flow and revenue that will be able to repay the money. That's where the real dirty work has to go in. How do we ensure that we have meters in all the consumers' houses, and these meters meet the technological requirement to drive revenue, and that this revenue actually comes in to repay all the financing of this sector.
Okay, it's an ongoing discussion. It's a developing story. We'll always get back to know to what extent the banks have raised funds, because according to the reports that we got, banks like Zenith Bank, Diamond Bank, Sky Bank, First Bank of Nigeria, Fidelity Bank, Guaranty Trust Bank, Diamond Bank, Union Bank, they've all shown interest in the power sector. And of course, one of the areas that they want to explore is to go abroad to sell bonds and all of those things. Let's see how this turn out to be, and we'll keep our eyes on the outcome of this gestures by these banks in terms of having to fund the power sector. On this note, I'd like to thank you for your time with us here on Channels Television.
Thanks for having us.
With Ayodiji Ebo, the head of research, Afinvest Securities Limited, and Oji Udemizwe, a financial market analyst. I want to say thank you for everyone out there for spending time with us here on Business Morning. Thank you for watching the program. I am Bolaji Akinwale.